Hi, I'm Mel Lopez, Chief Economist for ASEAN.
And I'm Peter Lundgren, founding CEO at Lundgren's Capital.
Welcome to Sound Economies with Mel and Peter, an East Meets West podcast by Lundgren's Investor Insights. Here we share what we're focusing at in economies and financial markets from the developed and the developing world. Hi, Peter. How are you so far this week?
Yeah, I'm fine. It's an exciting week. The markets are interesting. Business is good. And another good news the other day, one of the very, very prestigious organizations that are awarding some companies now and then, they informed us that we will get an award. We are not allowed to say more, but it's an award.
Just a
And
teaser.
it is, yeah, it's published, but so we're very excited. We're very proud. So it's been a fantastic week, yeah, honestly. What about your week, man?
Yeah, that's exciting. I want to know more about that in the right time. As for me, we are in the final stages of completing our next Global Quarterly magazine. So I invite our listeners to watch out for that. We're coming out with it real soon. We have a lot on our plate today, Peter. So just a quick run through of what we're going to talk about today. We'll discuss this comment coming out from an Alibaba executive about an AI bubble in the United States. We'll talk about if it's true. Do we agree? Is it something to be concerned about? And then we also consider the Weekend Development Forum in China that attracted several American and other foreign business executives and how this affects attitude or investor appetite towards China. Then we head over to the US market where there are declining forecasts towards or less optimistic forecasts towards US stocks. And the biggest investment company, BlackRock, providing greater attention towards alternative investments in building investment portfolios. And as usual, we will provide our global outlook, Peter. So I'll
Yeah.
kick it off with the discussion on from Alibaba chairman Joe Tsai. He recently said that there is this possible AI bubble coming out of United States. He's doubting that the $500 billion Stargate investment towards AI infrastructure, so that's mostly data centers, may not be entirely necessary. I think we talked about this a few podcasts ago where we asked, like, is that an overinvestment? And apparently, it's a view shared by an executive from Alibaba. So for context, like the 500 billion investment is a combination from several tech companies and they want to do that in the next 4 years. In contrast, Alibaba is investing 52 billion, so that's a tenth of what the US
Yeah.
is doing on cloud and AI infrastructure spread out in 3 years. So the disparity is really large. And one may argue that the US or these US companies are investing ahead in anticipation of future demand, which is, always a good business or a sound business strategy. But is it too much? And if it does turn out to be a bubble, then the effect on the tech sector and the overall stock market could be disastrous if this view holds. And yeah, are they investing in the right things is really the question. And
Yeah.
at the time when, the tech sector is really the one propping up the stock markets since last year and then early into this year, especially as consumer confidence is down. And of course, the ongoing tariff war is also stirring up trouble in terms of global trade. Is this something that should really merit a rethinking of the strategy in the US, Peter?
Yeah, it's absolute worth to listen to one of the top
Yeah.
persons as globally in this business. Yeah, if we use his arguments, then you could say there's maybe been an sort of an overbidding among
Mhm.
U.S. tech companies about how much they want to invest into AI related stuff, and then the question is also if they are building computer farms and infrastructure, is
Mhm.
that what we consider as real? AI investments, or is it simply to, yeah, to service future increasing demand of data traffic? The key is the tech stocks has gone up also due to the news on how much they want to invest into AI.
Yeah.
As a if you see the days on where it has been announced, the stocks has jumped.
Mm-hmm.
But if it's in reality more tilted towards data infrastructure, as of course they need it because AI means they need to handle truckloads more of data. That is
Yeah.
basically what AI is about. Yeah. So it's a new technology that includes much more data, and of course IT companies need to be able to handle that traffic. But that is a AI related investment, but not in what people would say
Research.
AI sort of, yeah, research and development. Or there's a big difference. It's actually a fair point he's bringing up, and it's interesting. And of course, as sitting on the top of Alibaba, they do study the US competitors in detail. They know everything what's going on here. It's maybe not a warning for US tech investors, but it's certainly worth to dive into what he's saying and reconsider, is the air getting thinner for the tech stocks? Right now, they're doing fine, but these are sort of the components we listen to and we use them in when we create our ongoing opinion. So it's a really interesting topic you are bringing there, Mel. And it's certainly it's not bullish for the tech stocks. Let's put it this way, yeah. If we need to
Right.
reconsider how we're spending the money. So yeah, we can encourage investors to dive into to this kind of comments. Yeah.
Speaking of tech stocks, actually, several American and other foreign business leaders flew into Beijing over the weekend. So China hosted a development forum where it's actually sort of their follow through to Xi Jinping's pledge to be more private sector friendly. So they're trying to
Mm.
woo more foreign investments into China in the context, of course, of US's trade protectionist policies. And it is another growth engine that they can tap at the time of course, slower global trade and as China tries to recover from its slump over the past 2 years. Among the headliners, so to speak, from this forum include Apple's Tim Cook, and then some executives from like IKEA, FedEx, Pfizer. So they're campaigning, China is campaigning against the trade protectionism of Trump. And they sort of provided a clue that China is willing to give more subsidies when needed. So that came from the China Premier Li Qiang. And some saw it as another, a step closer to bringing President Xi and President Trump together to finally talk and possibly negotiate over the tariffs that have been imposed and the retaliation from China.
Mhm.
It's a strategy. I see it as a strategy to bet against the tariffs. So while Washington is trying to block Chinese investments, Chinese companies from doing business with the US, China is instead trying to, okay, come here instead, come here instead. But yeah, there are existing prohibitions coming off from the US government about what US companies can and cannot invest in. And so that's quite of a tricky situation to navigate. But given the promise of like subsidies, incentives, this could be very attractive, especially when growth is hard to find elsewhere. So it's in Asia, it's in China, and that's what they're really counting on, Peter.
Yeah, yeah. Again, extremely interesting topic, and no doubt
Mm-hmm.
that China is fighting tough fight to get foreign direct investments again. It has actually dropped to where we could say it is almost it's a very low level. It's not zero necessarily, but it is at an extreme low level. The FDIs into China as a foreign companies investing into China. And that is, of course, a clear consequence of
Yeah.
um, the political headwind that has hit China since President Trump, he was president in the last, as the first period, so to say, and also European governments following up. Obviously, China is they're really trying to get some investments back on track, and that will do good for the growth in China. That is also obvious. We don't need to be a sort of a top economist or professor to forecast that. But other interesting perspective of this sort of event during last weekend are some Western corporate leaders, are they reconsidering China? As a,
Mm-hmm.
there's been pulling back from China uh, due to whatever, as a political pressure, um,
Right.
trade
Mm-hmm.
barriers, tariffs, whatever. That has made it difficult to do business with China, or more difficult.
Yes.
China is still a big exporter to both US and Europe, all
Yes.
over the world. It's not the key, but it has just been difficult to do new business.
Mm.
And the question is a reconsidering of China on the way?
Mm-hmm.
I could see it. And
Right.
one of the main reasons you mentioned also, Mel, is that let's face it, the outlook is 5% GDP growth across the Asian region, and that is
Mm-hmm.
this year and next year, and when we're looking forward. And Asia is simply the biggest economic region in the world. It is hard to ignore for a company. That is the key. The growth outlook in US is for the time declining. Yes, that is also obvious. The growth outlook for Europe, yeah, okay. Germany will boost a bit with some public spending, but otherwise it is very static. And
Right.
that's key. The big companies needs to be in the big economies, and they need to be where the growth is biggest. Otherwise, they don't remain the biggest companies in the world.
Right.
That is very easy. So our consideration here in our company is that there might be a shift in how um, at least some top commercial or corporate leaders are looking at China, and
Mm-hmm.
then that will also sort of go sort of through the system. It will spread to also to asset managers. A lot of international asset managers, they are still underweighted Chinese stocks. So
Mm-hmm.
despite that, the global stock market, maybe as we are talking about many times, that there are some clouds on the horizon, the Chinese stock market still looks healthy, and it is also from a pricing perspective, yeah, it's still okay. Yeah, it is not as cheap as it was last October,
Yes.
but it is still actually okay, and there are quite a number of really good Chinese companies to invest into. So this is how we take it. It is nothing that we say, okay, a new trend is emerging next week. We just make a note of it about
Mm-hmm.
is the world starting to deal differently with China and see it as the opportunity it is. So yeah, we stay tuned on your region, Mel. That's for sure.
Yes. Okay. And actually, I think we also discussed this a few episodes ago, but we previously noted that there could be some capital rebalancing among portfolios away from the US and towards probably Europe, or maybe this time it's towards Asia, more towards Asia right now. And we're recently seeing some more investment banks and investment houses growing less uh positive towards the performance of US stocks this 2025.
Yeah, the last how say it, major banks to join in lowering the forecast on the leading U.S. stock indices like S&P 500 was is Barclays Bank coming out the other day,
Right.
and basically what the banks are doing is they are causing the prior positive outlook to be a neutral outlook,
Mm-hmm.
meaning year-end forecast for U.S. indices. is now more looking like an unchanged market, as it's sort of 1 or 2 percentage points away from where we are now. So it means it's a very flat, sort of a zero development for 2025. Do we agree? Yeah. So it is a bit what we have talked about
Right.
so many times. Basically, we repeat it every week that the clouds on the horizon are sort of mounting, and this is what now the banks and in that sense investors are sort of taking into account. It is not a drama. It is no panic. It is not sort of going short advice. It is
Mhm.
simply to say it is not as attractive as it looked mid last year, and that is sort of the key. Is it enough to move out of a market? Basically not. From an isolated perspective, saying okay, it's not crashing. But are the other markets that are more attractive? And that is, of course, the question and the key. And we say yes,
Yeah.
but because US is lowered down, that is a predominant reason is actually the Trump policy. In particular, the tariff threats and the tariff policy.
Mhm.
And we can only repeat that he is ruining the economy. The best thing he could do for the U.S. households who voted him in the Oval Office is to support so much global growth, you won't believe it, instead of ruining it. So it is. This is much more sort of, as I see it, an internal or domestic U.S. Adjustment,
Yes.
because right now Trump he might hit some sectors across the world. Of
Mhm.
course, if he imposes high tariffs on different sectors,
Yeah.
yeah, it will be hit. But as economy as a whole, he is hitting the U.S. economy, and
Yeah.
there is no surprise because the policy he drives is destructing business and growth. So no news there, but it is the adjustment. We are not scared about the world. The world is actually very strong. The key, as where Trump is seeing this very very wrong, is that he believes that U.S. represents the world, and that is not the key. So we're not afraid of the world. We agree that the U.S. is basically the economy he is hitting the most, and fair enough. That leads to a lower expectations for the U.S. stock markets.
Yeah, and
So
he has a lot more tariffs coming, right? So he
mhm,
recently announced the 25% tariff coming in April for non-US made cars, which
yeah,
is which, follows the news that China's BYD recently beat Tesla for 2024 revenues. So,
yeah.
if you look a little bit closer, you'll see it's not necessarily just about bringing prices lower for Americans, but it's really something else, Peter.
Of course, the 25% tariffs on cars is basically what Europe or EU has
Hmm.
feared. Yeah. So
Yeah.
the automotive sector is suffering already. Also,
As
as in Germany, yeah, and this is what they fear. So that will be another story. But it is actually a sector that is already weak, and investors has left the sector. So yeah, but it will of course damage a bit more. And interesting is what happened the other way around. They are uh, surely U.S. bourbon will be more expensive, so your drinks will be more expensive on a Friday evening. But
you can't
otherwise, we'll
necessarily
see.
drown your worries away in a cheap way if it's
Yeah.
more expensive now.
So yeah, there will be more tariffs on different
Yeah.
stuff from US. We of course notice that a growing number of leading banks are lowering the forecast for the US stock markets into sort of a flat scenario.
And with that, Peter, actually, we mentioned that BlackRock, the likes of BlackRock, is
Mhm.
moving towards advising the inclusion of more alternative investment in investment portfolios. We have been, ahead in terms of alternative investments. But yeah, what does this say about this, declining view or positivity towards U.S. stocks at this point?
the move from BlackRock, and now we should say, as we have no business with BlackRock. We don't earn any any money to promote what they're saying at all. We simply just observe. Yeah,
Mm-hmm.
and of course, why we mention it is that we agree so much. It couldn't be it's fantastic, but BlackRock is just a tremendous big U.S. asset manager, and we should remember where they originate from. They grew big on sort of on the ETF market, meaning the electronic traded funds that are well known for being mutual funds, but with a lower cost. Yeah. So they come from what we would call the liquid market, the traded market, um, and it's where they got very big.
Mm-hmm.
Now they have for some time advocated that the very classical portfolio allocation standard called 60% allocated to stocks and 40% to bonds. And
Yeah.
that has been sort of the mantra since, let's say, Second World War. So sort of what we would call the newer financial markets,
Mm-hmm.
meaning if we are talking about like maybe the last 75 years. Yeah. And it is
Right.
what is ruling the world as a neutral portfolio.
Mm-hmm.
And to move away from that one actually is a large step, meaning you should have very strong opinions either to increase or decrease the number of stocks. So this is a true base in the industry,
Mm-hmm.
the 60/40 portfolio allocation. Now, what BlackRock has been advocating for since some time is allocation called 20/40/40, where the 20% is non-listed or alternative investments, and the 40% is classical listed stocks, and the 40% remaining are bonds as also classical. The way they argue, we agree a lot with, and the latest step what they have done, and this is how such a player like BlackRock actually not just maybe change the market by being vocal about something or analytic about something. That is actually their investment tool, their platforms that they offer to investment advisors now includes the 20% into alternative investments. So it means it is much more accessible.
Mm-hmm.
And when these things happen, it gets accessible as via an operational tool, then there's a very good chance that this is the way that the market is moving. More than 4 years now, we have run our own alternative investment funds. And
Yeah.
that is absolute as a sort of the same conclusion. This is the future. As a growing number of companies, they never get listed on the stock exchange. It is also well known that the big share of the wealth creation in a company happens before it gets
It's
listed, if it gets listed. So it is much more in the early stage of a company life cycle that investors they really can get good gains. So is it linked to bigger risk? Yes, it is. There is a bigger default risk. It is a bigger risk overall. A lot of
yeah.
things can happen that is won't happen or is less likely to happen with a company that is much more mature and is getting listed. But anyway, it pays off as the risk is worth taking for a part
Mm-hmm.
of the investment. As net, despite of the risk, it gives a bigger return. So when we operate with non-listed and we operate in so pretty early stage, it's where we will call uh, maybe seed capital. If you look into venture capital funds, yeah, we have it is maybe seed capital is before the companies are profitable.
Mm-hmm.
Um, so we operate in a gross return. When we look into some of the companies saying they need to yield 35% per year, but we
Mm-hmm.
also discount a bankruptcy risk as a default risk. But if we look into sort of a bit more sort of functioning companies within this area, we sort of have the opinion that it should yield or give like more than 20% per year.
Mm-hmm.
Uh, yeah, in return. And this is of course interesting. Are there swings in this? Yes, of course there are, but it is still an interesting part to have in the portfolio, and that is actually what BlackRock is arguing, and they have done very fine white papers. They are, as of course, the white papers are arguing their way,
Mm-hmm.
and we agree with their way, so it is biased, like any other. What else we say here in the podcast is biased. It's not necessarily biased in a way that we'll try to sell products. It is not
Yes.
what we aim to. But we also find it interesting to talk about how to build a portfolio. One thing is what's going to happen in the market, but how do you actually benefit from it, and how do you build your portfolios? And this is, as among many professional or very wealthy clients,
Mm-hmm.
we reckon that this is a way of building a portfolio since long. Yeah.
Yes.
And this is typical the people we speak with. So for us, it's natural. But the key is here that it is moving towards a general thinking in building portfolios among a growing number of investors. So that is quite interesting, and that will lead to a revolution.
Mm-hmm.
And getting access to the non-listed stuff is difficult. Yeah. That is the key. That is a key to success. But for investors, what they also need to be very observant about is that what we call the liquidity in an investment portfolio, the access to be able to sell some of the investments away within the normal 2 days. Because when we're talking about alternative investments, they are not liquid. So they cannot be sort of turned around or sold off easily.
Mm-hmm.
So they're there for a long time. So the key is to work with other parts of the portfolio that are very liquid and can be converted into cash
Yes.
in a straightforward way. So that is also very important to mention. But this is interesting, and we thought it was now there's sort of we just noticed that this very huge as manager in US they also even launched a sort of investment advisor tool, and that means that they are trying to move the market operationally that way,
Right.
and that is of course interesting to bring up and to talk about. Yeah.
Right. Well, actually, since we mentioned that, so alternative investment funds are increasingly becoming a reliable mechanism, so to speak, to ride on a certain sector or a certain economy's growth.
Mhm.
At a time when the U.S. is slowing down, parts of Europe entering zero growth, you can really look to these types of investments to perk up your portfolio, so to speak, because especially at the time when optimism towards the U.S. stock market, for example, is declining. Maybe just to wrap it up, Peter, for our global outlook, I can speak about my side of the world. So here in Asia, particularly in China, there are more reasons to stay optimistic. Growth is robust, and we see that economies are taking active positions to support or create growth opportunities, like we saw today with how China is trying to invite more foreign investments into the mainland while they are navigating through this increased volatility due to the Trump tariffs. They are finding a way to work around it and live with it. So that's a reason to be upbeat about the economy, Peter. How about for your side of the world?
Yeah, I joined the global outlook, and we do see the world as actually doing fine,
Mm-hmm.
and that's important. That is also important for the overall sort of approach to stocks and stock markets. So no change in that. We do, as mentioned, reckon how people are forecasting US. We know there's clouds on the way on the horizon. Interest
Mm-hmm.
rates are more set to go up than to go down. It can be that the European Central Bank will try to pressure it down the short end,
Right.
but inflation will win, and meaning that the longer end is more pointing upwards and downwards actually. So we that we reckon, but we still prefer to be in in the middle of the yield curve, and we like the credit risk in your end and corporate credit risk in general. So we are still pretty okay. And then of course we like the alternative investments as well. So that is after this this day's
Yes,
podcast
we
is
very much like.
no surprise. Yeah. So we do see a lot of opportunities. Yes. So we're happy. The sunshine is there. The clouds on the horizon. Yes. We are not. Are we scared? No. We are not. Not yet.
Right. And of course, we look towards these pockets of sunshine through the clouds, and we see
Yeah.
that there still are rays that are comforting us despite this high volatility environment. So that will be all for this episode. Thank you so much, Peter, and thank you to our listeners.
Thank you so much. Great to be here.
We'll be monitoring global developments and we'll share what's interesting in the next episode of Sound Economies, Mel and Peter on the Global Financial Markets, a podcast by Longines Investor Insights. Thanks for tuning in. For expert insights on the go, download the Longines Investor Insights app for free. For investors, we offer very exciting and high quality alternative investment funds, including our top rated Mutual China Fund. To know more, visit longinescapital.com.